Hello everybody, welcome back to our channel and thanks for tuning in. In this video today, we'll discuss three factors that are affecting gold and pushing the spot price lower. But just before we start, I ask you to click on that like button and subscribe if you are new to the channel. Currently, there is much talk about the possibility of many of the world's major economies falling into recession at some point in the second half of this year. Equity markets are seeing substantial price swings with a downwards bias. The transitory narrative to the inflation debate has now given way to more hawkish noise from most central banks as they start raising rates. At the recording time of this video, gold is trading at $1,810 per ounce, which means it's down over 11% from this year's high of $2,043 in March. But what's causing gold to drop so much, and should we be concerned about that? Specialists are saying that gold price will go lower and traders should sell at any price rally. As I am not a trader but a long-term investor and a collector, I could use the opportunity of falling prices to add more gold to my portfolio if it reaches levels around or below $1,750. The first factor affecting gold price is the dollar strength. Whether we agree or not with the reasons for it, the US dollar is regarded the #1 safe haven asset in the world. Old habits die hard, and therefore that title will stay for a little longer. The current dollar rally began a year ago and potentially still has more upside to go. Gold, like all the other commodities, is priced in dollars, and normally it goes down when the dollar goes up. Other factor that is affecting the gold price is the level of real yields in the United States. While the Federal Reserve is talking about raising rates, they have actually done very little so far. 0.75% is not a substantial rate hike to fight an inflation that is running hot or to affect the price of gold. Nevertheless, the market already priced in future rate hikes that are believed to come in the years of 2022 and 2023. At the beginning of the year, real yields across the Treasury curve were firmly in negative territory. Now, with the exception of the 2-year Treasury bonds, the markets themselves have turned those yields positive, and if the next inflation numbers come higher, that will push the real yields a little higher. Consequently, we might not have seen the bottom in gold prices just yet. The final factor affecting the price of gold is still the war between Russia and Ukraine. When gold reached $2,043 per ounce in March, gold price was trading higher with the premium due to the uncertainties caused by the war. As the Russian invasion to Ukraine completes now 3 months, the price of gold naturally lost this premium. In fact, the end of the war could make the price of gold slide further with a quick bounce back. So no one knows when the war would end, but it's not hard to imagine that the end of the conflict will create another good opportunity to buy precious metal. To conclude, the prospect of recession has been spooking the markets lately, as we see an increasing number of days when all asset classes are trading in red. Still, gold performance this year is far better than most assets. One thing to consider is that gold traditionally performs well during recessions. The ending of the fiat currency system is being labeled as the forthcoming, so stay focused on the bigger picture and don't be distracted by near-term noise. This will complete the video for today. Thanks for watching, protect your wealth, stay safe, take care.